Hello and welcome to session 20 of our Series 7 exam overviews, brought to you by Passing Score, where you can get apps and other exam prep help at PassingScoreFinance.com. In the next few videos, we'll be going over options, and there's a lot to cover here, so we'll be breaking this into three different videos. Let's start with what a derivative is. It's any security whose value is determined by some other underlying security. It's a contract between two parties. The underlying can be stock, bonds, foreign exchange, commodities, just about anything, but options, futures, and swaps are the most common. An option gives the buyer the right to buy a security for a fixed price known as the strike price before a set expiration date. The buyer of the option is long the position. The person who sells the option is short the position. There's two main option types: call options, which are the right to buy a security, and put options, which are the right to sell a security. And that's in the case where we're betting that the security price will be going down below the strike price. There are certain limits that exchanges have on options trading, and these limits can be on investors or groups of investors coordinating together. They're based on trading volume and outstanding shares to make sure there's a free flowing market. They can be on the plus or minus side of the trades. And the exercise limits are on options for any given 5 consecutive business days. And again, these are options exchanges and the OCC, which want to prevent manipulation or other types of uh, market behavior that's not desired. The option premium is what you pay for these rights to purchase or sell the securities. They're based on these 5 factors that affect the premium price: the market price of the option and security relative to each other, the time left until the option expires, any dividend payments that might be coming up, the volatility of the underlying security, and the rate of interest rates. The option value is broken up into two different parts. First, there's the intrinsic value. Now, this is the value of the option to immediately become profitable at that moment. So if the market price is $48 and you have a call option for $45 strike price, that means you're in the money. You have an intrinsic value of $3 right away. The remaining value of the option is the time value. This is the dollar amount that's given to price the time remaining until expiration. The option premium is the combination of this intrinsic value plus the time value. Let's go over an example of that. We have an option with a market value of $38 and a strike price of $212. Since the underlying asset market price is $221, we're $9 in the money. That's the intrinsic value. The remainder is whatever it is the time value. In this case, it's the option value minus the intrinsic value. So we have a time value of $29 for this particular option. If you want to close a position, you can either liquidate, sell your shares, exercise the option, or just let it expire, in which case you'll lose the full amount of the premium that you paid for this option. Calls are broken down into a long call or a short call. There's a buyer and a seller for each position. The buyer pays the premium and can gain up to however high that the security price goes. On the flip side, the seller is exposed to those potential losses because they're going to have to pay up. And so most of the time, they'll have that position covered by owning the securities, which they can deliver, or some offsetting other type of derivative position. Puts are very similar. They're just the mirror image of the call positions that we just saw. The buyer of a put is long the put. They pay the premium to have the right to sell at a certain price. And then we have the seller of that put who is short the position. They're obligated to sell at a certain price. And again, their maximum gain in both scenarios is the premium that they receive from the buyers. Let's look at an example of a comparison really between the long position buying the underlying shares outright versus buying the option on those underlying shares. So we have a market value of $40 and a strike price of $38 for a call. Now to have the exposure of 100 shares for a long position, we'd have to pay 100 times the $40 market value or $4,000. To have that same risk in an option position, you'd only have to pay $500, which is some of the power of the leverage of an option. Now, if the market price increases to $50, the long position receives is up by 20%. They have a 20% gain or $1,000. The option position, on the other hand, they've gained $500, but that's essentially doubling their money. They've made a 100% gain because of their leveraged position. On the other hand, if the market price remains zero or zero change, remains at $40, the long position has a zero gain. They're exactly flat, nothing's changed for them up to the expiration date, but the option position will lose their $500 premium. They don't have any more time value left in their option. They've lost 100% of their investment. And in the case of a downturn in the market price down to $25, we see that the long position has lost $1,500, but the option position can only lose their premium that they've paid for that option. So they can only lose that $500. So they're doing better than the investor who took out a long position, at least in the short term, up to that expiration date. The long position could still benefit from future gains since they still hold the security, but the game is up for our option holder. And here's a visual of how that works a little bit for the long call, the buyer. You see that the stock price has to increase uh, so that they can gain back their premium first above that stock price before they have any type of real gain. That $500 gain that we see on the right is break even for the option since that pays for their premium. Meanwhile, the stock holder is already has a positive gain any movement above their initial purchase. And in both cases, they have unlimited potential gains. The seller of the call is short the call, and they have a very different kind of scenario. This is the exact same position from the seller of the call's point of view, and they've made their $500 premium that we see on the left. As long as the stock stays flat or goes down, they've made that profit, and that's the maximum gain that they can have. On the other hand, as we see on the right side of the graph, their losses can be unlimited. They're the mirror image of our long call position. So that's very important for them to cover their position so that they aren't exposed to those types of unlimited losses. But again, these are both the same position from different points of view, from the buyer versus the seller of the option. And that's it for our basic overview of the options section. We have two more videos going over more detailed and complex scenarios. And if you have any questions on what we've gone over so far, please feel free to email me at john@passingscorefinance.com. And as always, good luck on your exam.